Shane, good timing on this question, mate. This is huge. As the massive ETFs now come into the crosshairs, as these all have unallocated on and off ramp flywheels. Yes, and once again, the smaller and less obscure silver market provides us the better window into what the same actors are doing in the ring-fenced, much larger gold ETF, GLD, that big monolith. I recall discussing this subject back in February, and where we focused on look, we all remember the implausible thousands of tons of additions that were added following the EFP blow up back in March and April, where there was no physical around and suddenly everyone wanted it. Where was the only place to go? You couldn't buy it on the physical market, so you went to the ETFs. Oh my goodness, they seem to be able to be loading hundreds and thousands of tons in when we knew there wasn't any. So obviously that created an issue, and that's when BlackRock issued a warning, and that was in February 2021, I remember, as the silver short squeeze drove silver into the 30s. Bearing in mind these guys have bet against that. And what was absolutely clear to every silver wholesaler and bank was that this was a warning. This was a warning to bail out the SLV's authorized participants. These are the APs who work with the trust to create new share baskets of the ETFs. And I remember the wording was pretty clear. We may be unable to acquire enough of the metal, and that SLV may suspend or restrict the issuance of baskets of shares. Well, I mean, give your head a shake. I mean, this announcement followed an emergency meeting with these authorized participants unable to supply. And at the time, there was a 1 week window where 1.5 billion in physical silver inflows were recorded into the trust. And this is when the warning came in, because it clearly wasn't coming in. And going to market, really, this is the point that should be made. Going to market to obtain this amount of silver would have driven silver to somewhere between 50 and 80 bucks overnight. But worse, for the market making insiders betting against silver, such a bid-only move would have triggered in fresh demand in sufficient size to bankrupt the too big to fail authorized participants. And of course, this embarrassing BlackRock admission to not supply silver cuts the same way. This is a point I'm trying to make for the much harder to read gold ETF, and specifically talk about GLD in this case, as some Swiss ETFs are actually physically backed, and as are Sprott, etc., etc. But I mean, I'm specifically focusing on GLD and how it interconnects with the COMEX. But what it exposed was that these so-called investment hedging ETF vehicles do not represent or discover a real supply-demand price. Otherwise, you'd be forced to go and fill those vaults. Now, what it exposed was that the on and off ramps are not physical. And as soon as the rubber met the road and the physical demand meant the unallocated gold and silver position representing these gold and silver baskets had to be turned into real physical bars for delivery, and the APs, the LBMA gatekeepers, refused to go to market to buy the physical, which would have seen a substantially higher real supply-demand gold and silver price emerge. That's supposed to be what markets are supposed to do. And we also know that while the gold and silver bars are signed off as existing, that they're also allowed to be bet against, openly short sold, and essentially, what is that? Rehypothecated. But here's where it gets really interesting, and I don't think anyone's focusing on this. The unallocated flywheel that has allowed the related gold ETFs to be managed by the authorized participants using these holdings to bet against GLD prices from rising above their managed COMEX pricing envelope is going to have to be backed by physical. This is a huge deal. This will be a game changer, and it'll allow the funds who must use ETFs, these hedge funds that come in and out all the time, but usually get flipped out again because, by the way, you can play with that game. But if it was physically backed and they were really gaining exposure to gold and silver, and then you would see a real uncapped return. They would get a real uncapped return on these investments as those prices rose, as these funds came in to buy and were not rinsed back out again. Now, once let loose from being suppressed by the freshly compliant authorized participants managing these baskets, it's going to make these instruments very attractive to those captive funds who are unable to gain exposure to physical bullion. And there are many funds, it's not in their mandate to be able to buy physical. So it's important. This is a huge deal.
Andrew, as we come to the end of the year, what can our Live from the Vault viewers, what can they expect for gold and silver moving forward?
Shane, good question. Very short term, with the BIS, again, successfully containing the gold price to square off these excess unallocated contracts. By the time we publish this interview on Friday, we will be getting the next CPI print. And unless you're a stacker, I'm suggesting really kind of wait till the dust settles. Then we expect a sizable rally to develop into the year end, and structurally, even with the dilutive over-the-counter paper hedges in play. 1900 is fair value, but seasoned traders really ought to expect some volatility, as the BIS will still likely want to have a last kick at the can. So we may see gold being contained until the last possible minute. That's not really what we expected, but it's what's happening. But given the deeply technically and fundamentally oversold condition, I see little to suggest that we should close below an optimum 1805 to 1830 window. I know that's a big window, but essentially above 1800. And that's not where we are at this moment when we're playing, we're seeing this gaming going on in a very thin market today ahead of CPI. Now, the sweet spot, people say, what is the sweet spot? It's the balance level where the BIS derivatives can be squared as cheaply as possible, while at the same time exposing the BIS unallocated positions to as few sovereign competing bidders as possible. And after such heavy containment, gold and related silver are coiled, and January will be explosive. Now, structurally, following the November BIS OPEX defense, all the spec longs that were added above 1800 gold futures, they've all now been flushed out by the House. And further spec sells into a very strong physical market will be naked short, with insiders exposed to backwardated delivery obligations, those that cannot be offset, that is, with a spec short. They'll be taking the long side. And you're going to see it one more time. They always win. The House always win, only because of the paper dilution, which is going to start to evaporate. So safe haven demand is now accelerating, and what it's going to do is underpin paper market sells along the way, even before we get to the end of the year. Now, stackers right now are having a whale of a time into unallocated position squaring discounts, but for traders, perhaps look for a buy stop in at around 1800, and this would unleash a very large coiled, physically driven rally, the regaining of 1800. And so, I mean, if you look at the daily charts, my God, the daily charts are so deeply technically oversold, and silver in particular, but both. Silver is actually more deeply oversold, technically oversold, than it was in March 2020. The price